I will read out from this document, but please bear in mind that the document contains graphs and small data sets. This study is for British Coal Staff Superannuation Scheme. Summary of the results of an asset liability modelling study. Introduction. 1.1 Following the valuation of the scheme as at the 5th of April, 2000, the Trustees Board of the scheme requested Watson Wyatt to undertake an asset liability modelling (ALM) study. This note aims to outline the analysis that is relevant to the financial interests of the members of the scheme. 1.2 The analysis shown in this paper focuses on the level of equities earned bonds held by the scheme. However, similar analysis was undertaken into all the major assets such as property and private equity. 2 Details of the analysis. 2.1 The aim of our analysis was to provide a framework for discussion into the risks and rewards that the Trustees Board, and therefore members, could face from various asset allocations for the scheme. In addition, output was also generated for the guarantor so that the financial risk arising from the scheme for the government could be assessed. The following is an outline of the analysis relating the members' financial interests. Rewards. The likely future levels of bonus augmentation pensions paid. Risks. We measured 2 risks facing the members. These both relate to the risk of standstill being applied to members' pensions. Standstill is the mechanism whereby bonus augmentation pensions are reduced in the event of a valuation deficit in the bonus augmentation fund. The risk of standstill occurring in general, the risk of deferred pensioners receiving less than their current bonus augmentation pensions. 2.2 We also provided the Trustee Board with analysis into likely levels of cash flow to and from the guarantor arising from the guarantee. From that analysis it is possible to make inferences regarding the financial value of the guarantee to the scheme by comparing the value of the guarantee with the stream surplus arising from the arrangement. 2.3 The analysis was based on the scheme's assets and liabilities. As at the 5th of April, 2000, before the recent large falls in equity prices. 3. Methodology. 3.1 Asset liability modeling is a technique where the future of the scheme is projected forward using an economic model to assess how it behaves in different environments. Continued on slide 2. Continued from slide 1. Process is repeated many thousands of times to give a feel as to the likely range of outcomes, and also as to how poorly the scheme's investments could perform. 3.2 The main basis for calculating the financial position of the scheme in the projections is the valuation methodology as used by Government Actuaries Department, the scheme's actuaries, for the 2000 valuation. However, we also produced projections allowing for a possible change to the valuation methodology. 3.3 Clearly the process is dependent on the model used, and a summary of the model, and the assumptions, are shown in the appendix to this note. The table below shows the main assumptions used. Assets /expected real return *% per annum * under the table is a short explanation. Thus, the real return is the excess of price inflation as measured by the retail price index. The list reads as thus. First line, equities equals 4.75% per annum. Second line reads as bonds, open brackets, index-linked gilts close brackets 2.00% per annum. Third line reads as bonds, open brackets fixed interest gilts close brackets 2.50% per annum. Fourth line reads bonds open brackets fixed interest corporates close brackets 3.50% per annum. Final line reads property 3.50% per annum. 3.4 In addition to using these assumptions, we also investigated the types of economic conditions that could lead to very poor outcomes for the scheme, or for the risks to members' bonus augmentation pension to be very much increased. 3.5 The projection period used was 9 years, aimed to be equivalent to 3 actuarial valuations. We also made projections over longer periods, mainly 30 years, to test the very long-term resilience of the scheme to the conclusion based on 9-year analysis. 4. Results. 4.1 The results of ALM analysis can be difficult to interpret, as they are effectively a summary of the outcome of scheme's future 10,000 projections of the scheme's future. In this paper we show results in terms of the median, which is in the middle of the 10,000 runs, and gives an indication of the result we expect. The lower quartile and the upper quartile, which give a 1 in 4 chance of the results being worse or better respectively than the figure 4.2. The work on which we report in this section was principally aimed at determining an appropriate asset mix, but it also shows the probability of certain events occurring to benefits. We comment on those as well as the investment conclusions. Please go to the next slide. Continued from slide 2 and begins as thus. 4.3. The following graph shows the range of likely bonus augmentation pensions that might be paid to members over the 9 years from the 5th of April 2000. The figures are in pounds million, are shown as the current capital value of the mainstream of projected payments, and include the current bonus augmentation pensions. However, for reference, the capital value of the current level of bonus augmentation pensions over the next 9 years is £786 million. Still will occur at some point in the analysis would therefore indicate an expectation further risk, but not considered by the trustee board, that actual bonus payments will be higher than current payments being in aggregate over the next 9 years. Please study the graph shown on the top half of the page. 4.4. The graph above would support an allocation of at least 70% to equities. This is based most of the statistics outlined in 4.1, increasing as the allocation to equities increases 70%. Thereafter we see a trade-off, higher equity allocation for the analysis indicates an expectation of higher bonus augmentation pensions, but also the possibility of much lower bonus augmentation pensions. 4.5. The lower graph shows the risk of a call-on fund from the bonus augmentation fund. This would usually be caused by a deficit in the guaranteed fund, the pot of assets that pays the main guaranteed benefits at an actuarial valuation. This call is important because, if it happened, a standstill would be almost certain to occur. Please study the lower graph, and then go to slide 4. The bonus having been reduced by inflation increases on the guaranteed pension. 5 other asset classes. 5.1. Similar analysis was produced to consider the strategic weightings to other asset classes. The following were suggested: equities, that a relatively high weighting to overseas equities could be justified; bonds, that the current equal split between fixed interests and index-linked remained appropriate, however there were grounds for increasing the allocation to corporate bonds; property, that the scheme should maintain a meaningful weighting, perhaps 10% to property. Please go to slide 5. Continued from slide 4. There are no graphs on this page. 6 other assumptions. 6.1. The ALM also investigated the types of changes to assumptions that would be highly likely to lead to either poor results or to cause a high risk of poor results. The following were found to be the cause of such outcomes: inflation, a prolonged period of negative inflation; corporate profitability, a prolonged period of very low profit growth for companies; valuation methodology, a move from the current method of valuing the scheme, which is primarily based on the stability of long-term dividends, towards an approach that valued liabilities with reference to long-dated bonds, and took the assets at market value. 7. The guarantee. 7.1. As part of the ALM, the nature and size of possible cash flows to and from the guarantor arising from the guarantee were investigated. It is acknowledged that the investigations into the pricing and value of a guarantee are subjective, and depend to a great extent on the assumption made. In addition, the figures were calculated before the recent falls in equity prices, which would be expected to increase the costs, equalizing cash flows, on the basis of the assumptions set out on this paper, and assuming that the guarantor did not want to hedge any of the risks involved with the guarantee. Then we estimate that the cash flows arising from the guarantee would be equalized, in value terms, over the next 30 years, if the guarantor received around 15% of any surplus, with the balance being passed to the bonus augmentation fund. However, in general, for a commercial contract it would be expected that the entity financing the cash flows, in this case the taxpayer, would expect to receive some recompense over and above the amount needed to equalize cash flow, and would need to take account of the risks that the actual costs of supporting the guarantee could be far higher in adverse circumstances. The appropriate margin is generally a commercial or political matter. We also note that the government is probably the only body prepared to provide the guarantee, as it is unlikely that any other organization would be willing to underwrite such large risks, hedged risks, if the guarantor were to attempt to minimize the risk of the guarantor by actively trading financial instruments, similar to a bank offering a guarantee or option, then the costs would be increased towards 40%, 7. 2. It is noted that the costs indicated in this section do not allow for expenses of profits. Continued from slide 5. 8. Summary 8.1. Based on the results of the ALM study, the following was suggested: retention of an equity allocation of around 70%, retention of a material allocation to property, at around the 10% level, within bonds, retention of the equal split between fixed interest and index-linked, but an increase to the corporate bond weighting, recommendation of where to invest for best return on investment. N.P. Horsfall Watson Wyatt LLP December 2002, N.M. Watts, Watson Wyatt LLP, December 2002. The services of Watson Wyatt worldwide in the UK are provided by Watson Wyatt LLP. Watson Wyatt LLP is regulated by the Financial Services Authority in the conduct of UK investment business. Continued from slide 6, Appendix, Asset Return Assumptions. There can be a tendency to overstate the expected long-term return on equities due to the exceedingly good performance of these markets over the last 2 decades. Our aim is to avoid this bias by analyzing market returns over a wide range of economies and using the longest available time periods, around 100 years. In addition, we examine the reasons for past performance and ensure there are sound reasons for projecting forward any past trends. The aim is to arrive at a long-term neutral or average approach. The return assumptions given below represent expected market average index returns for each asset class that an institutional investor could expect to be achieved through a passive investment management approach. As such, they do not include expected premiums for active investment management, or any offsets for the costs of managing active strategies. Our assumption reflects a combination of rigorous historical performance analysis, the forward-looking views of the financial markets as revealed through the yield on bonds, and the views of investment organizations. The returns and risk expectations for each asset class incorporate assumptions about historical return relationships, current financial market conditions, and the degree of global capital market integration. The following table shows summary statistics for the major asset classes included in the Watson-Wyatt asset model. All figures are for real returns in excess of price inflation. Please read this small data set below. Correlation assumptions. The correlation of returns between asset classes describe important characteristics of the asset model, in addition to the expected annual return and the standard deviation of annual returns. Recent and long-term history is used as a guide to setting these parameters. The table below, see next slide, shows the key correlations of real one-year returns between assets in the Watson-Wyatt asset model. Please see slide 8. The data set above is a remnant of slide 7 and the end of series 4. See me in series 5.